Alright guys, welcome back to another video. So today I want to talk about one of my most hated videos that I have. Actually, surprisingly in terms of hated, it doesn't have that many dislikes, but the comment section gets pretty brutal. So back in about May-ish of 2019, I invested $15,000 into Cardone Capital. Now for those of you guys that follow the portfolio and the channel pretty religiously, you know $15,000 in comparison to the entirety of the portfolio, which is at one point 430-ish or $1,000. Now we're around 370-ish, maybe a little bit more due to today's kind of 7% jump up or anything like that. But you know that it's a relatively small portion of the portfolio. But the amount of comments that I've been getting on this, and thankfully, and we'll kind of touch into this video has been picking up a lot of steam, I guess because of some of Grant's recent videos, some of his layoffs and what have you. But I got some really interesting sort of discussions in here. So if you guys want to see some troll action, maybe me kind of defending Grant, feel free to check out this comment section of this video. It's my $15,000 investment in Cardone Capital. And I made this back in October timeframe. And it's been picking up a little bit of steam. We'll look at the analytics in just a second. But you know, you have some things like COVID-19, waited for Grant to go into hiding. We've all been scammed a time or two. At least he's 10x his attorneys. Thank you, investors. Grant Cardone Capital is in trouble. Lawsuits are coming. Get your money out now before it's too late. Uncle G's looking desperate. You know, where are my funds? Grant Cardone jumped ship with all my money. You know, these sorts of I guess comments are people that don't necessarily have any skin in the game and maybe just listening to headlines, or people like me, Kevin. Not to say that they're wrong by any means, and in fact I'll kind of go through the K1 form that I got today. But and to be honest, I don't necessarily know what the hell I'm looking at. So to be 100% honest with you at this point, before we jump into that aspect of things, I could have lost half my money. And, you know, I think anybody that knows how to read these sorts of things probably can give this to Meet Kevin or do that themselves and be like, hey, Matt, yeah, you kind of lost half your money. But we'll kind of look deeper into it and get a little bit more into the year-end 2019 overview of all the portfolio, the 5 different apartment buildings that we kind of have some money in, and we'll kind of dive a little bit deeper to see, is this really a stupid sort of Ponzi scheme, or does this actually make a little bit of sense? So before we hop in to the actual details of everything in the K1 form, as you can see, the video has been picking up a lot of interest lately. Not a lot, but you know, a couple hundred views a day over the past, I guess, 2 weeks or so, and that has led to a decent amount of comments and a decent uptick in revenue as well. So hopefully this will help answer some people's questions and maybe give them a little bit more foundation as to whether or not, hey, did Matt actually get scammed? So we'll kind of hop into this. So the first thing I wanted to kind of pull out is the K1 form. Now, appreciate that some of this stuff is going to be hidden just based on the fact that, you know, some of this stuff is proprietary to me. And to be 100% honest with you, I could get in trouble with Grant Cardone by sharing some of these things. So I might eventually have to take this video down because it might be revealing too much. But let me open this up, I guess, fully here. And maybe we can scroll down a little bit at a time. So appreciate that I'm not going to share absolutely everything in here, but I think one of the first things that you could probably look at here is net rental real estate income loss, $8,600, which initially I kind of freaked out about. But one of the first things I kind of want to look at quickly is here. So here you're able to see absolutely everything. So I'll share this 100% transparent with you guys. So 0.03% is my ownership in the entire, I guess, position of Cardone Equity Fund 5. And we'll talk a little bit about that in a bit. But if you take $15,000, which is the amount that I invested, and divide that by 50 million, which was what the Cardone Equity Fund 5 was filled to with the crowd fund that Grant had filled out, it equals to 0.03%. So that in a whole makes sense entirely. At first, what I was trying to do is try to estimate the purchase price of all the properties, and I was like, this is not 0.03% of all these properties. And it makes sense because Cardone Equity 5 and Cardone Equity 6 were combined together to then purchased the 5 properties, which we'll kind of get into a little bit later. But that $150 million was crowdfunded, $50 million for Cardone Equity 5 and $100 million for Cardone Equity 6, which is it was a fully accredited investment. So you need to invest at least $100,000 to get into Cardone Equity 6. You just have to invest $5,000 to get into Cardone Equity 5, which is for non-accredited investors. Keep in mind, in order for this to go through, the SEC had to approve it and go through, that sort of aspect of things for it to be approved for non-accredited investors. And so I'm a non-accredited investor at the moment. My portfolio value is less than $1 million. And so I had to invest to that non-accredited aspect of the portfolio. So immediately what you see is the capital contributed, $15,000, and immediately the net income loss. Okay, cool. But then you immediately see other increases, offsets all that, plus my distributions, and then my ending capital amount is $64 more than what I put in. So I have no idea what the hell any of this means. All I initially see is this loss of current net income of $8,600. And part of me is just like, well, is that the depreciation coming from the assets? And another thing that I kind of want to highlight as well, because this is kind of important and kind of cool actually, is right above this, you can see the financing aspect of things. So I have my capital contributions, and then I have my financing aspect of the portfolio, which is around $30,000, about $29,750 or so. So this $15,000 has now kind of gotten me $45,000-ish of real estate, is the way that I'm kind of viewing it. Partially to fund, maybe some management fees and some expense ratios, which I'm sure you guys will mention in the comments. So, of course, you have to pay the management to manage the property. It's not going to manage itself. So part of that obviously goes to that. So completely understand. And then the other piece goes to basically the interest that now I guess hold as a partner in the portfolio. So looking at it, you can see it's about 66 to 33% in terms of loan value to the actual equity value that we kind of hold. But the equity value at the same time, is kind of interesting, because not all these properties, we'll kind of get into this a little bit more detail, is basic conventional sort of loans. Some of them are interest only loans. So we'll get into that a little bit. But the thing that immediately kind of struck me was this $8,600 loss. Now, some of you might immediately be typing in the comment section, wow, Matt, within 7 months, you lost half your investment. You're an idiot. And it could be very well true. I have no idea what this means. But the way I look at it is that I'm not sure if this is basically a combination of, say, the total income as well as the depreciation. And I know in 2019, based off all the volatility that we're seeing in the market, we were able to accelerate some of the depreciation. Normally the depreciation is supposed to go over 39 and a half-ish years, because it's multifamily commercial sort of property. And you're supposed to be able to write off, 2 to 3% of the property's value over that 39 and a half year time period. So every year, 2 to 3%. But in this particular case, I think they allowed you to accelerate the amount of depreciation you could take in 2019. And for those of you guys that follow the portfolio a little bit, this is eerily close to around what income I made in 2019. Now, of course, I think I didn't make exactly $8,600, but I think I made close to like $7,500 or $8,000 in terms of dividend income outside of any sort of retirement accounts. So I basically would have to pay close to $8,000 out of pocket in taxes, which for my tax bracket, if they're non-qualified dividends or just dividend taxes alone, is going to be on the order to like $1,000 to $2,000, because I do invest in a lot of real estate investment trusts, and I do invest in a decent amount of partnerships. So that alone is going to be able to knock off a decent amount. If this is depreciation, of course, a lot of that extra, taxes that I would have to pay, because this fully offsets any sort of investment income that I have from other investments, like dividends coming from my individual brokerage account or anything else like that. So that being said, they do kind of get into more of like the information where it kind of breaks down some of these things. So you're able to see rental income loss from Cardone Equity 5. and then you're actually able to see a decent amount of the information, like where the losses are coming from each individual uh, I guess, LLC that owns each individual property. So like I mentioned, there's the 5 different properties that we have ownership, and then the, I guess, overarching management company that kind of has the overall ownership in these Cardone Equity 5, I guess, assets. But what you can see is all these properties are running at a loss in terms of net income, but then you have these adjusted basis of assets that are positive. So I'm like, what is exactly going on here? You know what I mean? I mean, you have like all these different assets that kind of come in, and it's just real interesting. Like, I don't understand what the heck is going on with respect to that. And you kind of scroll down a little bit more, and it goes a little bit more into detail about it, how you have like each individual loss of all the different things, and then all the adjusted bases. And so yeah, to be 100% transparent, don't know what's going on the surface. Immediately when you look at this K1, you're gonna be like, this guy pissed away $8,600 and is losing money, and you could very well 100% be right. I'm not gonna, I guess, not acknowledge that. I mean, I don't know exactly what's going on, so that's why I kind of hope that one of you guys takes the time, if you know Kevin or any sort of real estate professional, to like share this video and see what the heck is going on, because I would anticipate that they would keep net rental income and depreciation separate, not in one line item. So that's where I immediately kind of get drawn to some concern. Then what I wanted to do was just take a quick look. It's like, well, is all this, I guess, Cardone Equity 5 sort of stuff hemorrhaging cash like this K1 form says it is? And like everyone in the comment section has already written and says that it is. Did I lose half my money like within 7 months? I mean, I have to have, right? I mean, that's what's in the K1, and that's what everyone says in all the YouTube comments, so it must be true, right? And I still don't know, right? I mean, some of this stuff can be fabricated. I personally can't say for sure, but this is what the documents say coming out of Cardone Equity 5 Fund 5, Cardone Equity Group, coming out of Florida here. So we have all the market overview, 2020, yada yada. That's all out the window now because of everything that's going on in the market, the volatility that's going on in the market. Another thing to look at, so this kind of goes deeper into what I was explaining earlier. Cardone Equity Fund 5 raised 50 million. Fund 5 and Fund 6 with Grant parallel invested in these 5 assets. So 50 million from Cardone Equity 5, 100 million from Cardone Equity 4. Sorry, I thought it was Fund 6. So I'll have to change that. And Grant raised $150 million. Okay. So acquired 2,000 units, 471 million, which is pretty wild. And all the different 5 properties, and then they're talking about the different funds that you can invest in if you're interested. Keep in mind now, at this point, I've made $281 from cash flow in 2019, which is 5 months worth of cash flow coming from the property, and I've continued to make the last 3 months, so I'm up to about $450 or so in terms of total cash flow back. So about 3.5% of my money back at this point in terms of cash that I've gotten out of the fund, which has now been fully offset. At least the $281 that I made in 2019, based off of that half of my net investment going down the drain. So I'd have to pay no taxes on that $281. And at least I get to take some of that $8,600 loss, quote unquote, and write that off against some of my individual brokerage account investment dividends that I got, or short-term capital gains, or anything like that. So nice to know. And so quick rundown. So we have some Delray property, which is in Delray Beach, Florida, $92 million property. Looks pretty nice, 346 units, quick overview. Interest-only loan for the first 5 years, $60 million in terms of the loan. Looks pretty decent in terms of everything. Cash flow is just okay, but keep in mind that that they closed this in 2018 timeframe. So yeah. Did I mess something up? I think I might have when I wrote all this stuff down. Anyway, we'll figure that out. Riverstone, which is actually one of the reasons why I invested in this, is because I know this area. I know a lot of people that live in Sugarland, Texas, a lot of friends and family, not family, but friends that have come from Sugarland, and a lot of people that live directly south of Sugarland. Shout out my boy Stevie. Um, and so I wanted to invest in Sugarland. I was like, holy crap. I mean, they're investing, in a place that I know relatively well. And I know that Sugarland is infamous for having a lot of nice homes and a lot of people live out there, but not a lot of apartments. And I know it's grown over the past couple years. And beautiful place, right? So this was built in 2018 and 350 units or so. And I was like, crap. I mean, that's a nice place. So we're able to buy it for 42 million in terms of what the loan is. So obviously they had to pay a little bit of money, interest at 4.5 or so percent, and they bought it in February of 2019. So um, once again, pretty decent cash flow in terms of everything. Um, can't complain. Um, so yeah. Um, Third one is from Sunrise. It's a $93 million loan, so it's over $100 million property, 500 units, pretty wild. They only owned it for about half the year. Same thing with Naples, only owned it for about half the year, but it's probably close to a $100 million property. Built in 1990, so a little bit older, but still about 450 units, which is pretty crazy. You think about it that way. So probably close to $200,000 a unit, which is pretty wild. Then you have this bad boy, 360 units, $50 million investment in terms of a loan. So it's probably closer to $65, $70 million in terms of the overall purchase price of this bad boy. So still, again, probably around 200,000 per unit or so. And you can see that the income coming from these is relatively decent. So I kind of hopped over it really quick. But what I did was I made a little spreadsheet for us here, because that's what I do best, and might be able to give us an idea as to what we're looking at. So overall, key figures to kind of keep in mind: 150 million was invested in this fund in 2019 timeframe. So of that, some of that was used to purchase Del Rey, some of it was used to purchase Riverstone, and then eventually throughout the year it was used to purchase Sawgrass, Naples, Breakfast Point. So actually, when I was investing, I only knew that these two properties were in the fund, and what really drove me was Riverstone. And so that's why I brought in a lot of my money and invested a lot of my money into Riverstone. And I messed something up here, so give me a quick minute. All right, so thank you for your patience. I had to fix something. I accidentally had this revenue up here, and I wanted it to be below this fiscal year 19 sort of range. So what I have in here is basically what Grant and his team had put together for the revenue, net operating income, debt service, capital improvements, cash flow for each one of these properties. And quick, the story is, throughout the year, the properties cash flowed about $5.4 million, and of that, it was about 22% of the net revenue that we got, or the gross revenue rather, coming from the properties. Overall, net or gross revenue came in at about $24 million. But keep in mind, not all these properties were owned for the entirety of the year. Breakfast Point has been since the end of August, or is that July? I don't know. Naples was at the beginning of July. Sawgrass was at the very beginning or end of June rather. Riverstone was February 1. So if you were to kind of annualize those things, you can immediately kind of come back in here and fix things up. So you can see revenue coming from Del Rey is about 7 million. Revenue coming from Riverstone is about 6.5 million. Sawgrass, which is that big boy, is around 11 million. Naples is around 7 million. Breakfast Point is around 2.6 million, for a total of 34 million. Now, before we hop into more of the nitty gritty of the details, what you can immediately see and kind of understand is, okay, so if we're looking for cash flow, right, the number that I've been kind of reporting to you guys, that 4.75%, what you can immediately see is, okay, this 5.5 million or 5.4 million divided by the $150 million gives you about 3.6% in terms of cash flow for the year, right? I mean, if you were kind of keep everything annualized for the year, that's where you're looking at. Not very good, right? But keep in mind that is only 150 million invested for all of 2019, and these are fiscal year 2019 numbers. So you can't include annualized or all 12 months in all those because they didn't own the properties for all 12 months. So I kind of normalized it, right? Took out and added, say, if everything would remain the same for the next 12 months. Now, I know a lot of you guys are going to type in the comments as well that, hey, Grant's giving out discounts and yada, yada, yada. We'll get into that in just a moment as well. So looking at the 12-month rent roll, that's kind of how we get everything to the 34 million. So from 24 million to 34 million, because now everything is 12 months. Net operating income, so after kind of paying all the management and upkeep and everything like that, you end up with about $20 million, $20.5 million. Then you have to service the debt, which most of the time is interest only at the moment. So you're going to take that, pay $11.6 million just to pay off any sort of interest, some of which is higher than others, right? So some of which, generally speaking, is about 33% or so of what the actual revenue is. So that's pretty interesting. I thought it'd be a little bit more than that. Then you have almost $1 million of capital improvements. If everything were to kind of come out, I'm sure that some of them will come down, some of them will kind of come up, because obviously Riverstone, they didn't really do anything in terms of capital improvements. But overall, you can kind of see it ends up being about $1 million to $2.5 million for each individual property. And so for full year, if you were to kind of have it for full year 2020, if everything were kind of be equal from 2019, you'd walk away with around $8 million in terms of cash flow. Now, $8 million in cash flow divided by the 150 million, still not all that impressive. It's about 5.4%. Now, keep in mind, these are generally speaking A plus, B plus sort of properties. So, to be honest with you, if you were to buy this entirely outright, this 5.4 wouldn't be that bad. That being said, these are leveraged properties, interest only. And so that being said, I would anticipate having slightly higher cash flow rates. I mean, I was expecting probably closer to 6-7%, just based off the fact that, we have interest and loans to be paying. We didn't buy these things outright. And so I was expecting to get a little bit of leverage that would increase our cash flow just a little bit. But that being said, I mean, the market was pretty high in 2019 and probably at the peak, maybe some could say. And so maybe some of these properties were purchased a little bit overpriced. But one of the things that I kind of want to look at here is cash flow divided by the revenue. So I messed this title up here. And immediately what you can kind of see is of the cash flow that we're getting, it's around 15 to 25, maybe even 30%, depending on what asset we're kind of looking at. And so that being said, you can kind of average everything out to about 24-25% in terms of the net revenue that we're kind of getting through the cash register. So the way I kind of interpret this is a lot of people were kind of saying, oh, well, Grant might be giving discounts to be able to get 12 months rent early, or 3 months or 6 months rent early. So yes, I can understand where he's kind of coming from. If I were him, I would say, yeah, I mean, give me 3 months, 6 months, 12 months rent in advance, and I'll give you 3 months for free, or a portion of some rent for free, just so that I can get the money up front to make sure that I have enough money to be paying off this debt service that I have to do. Keep in mind, any sort of cash flow that kind of comes in the door, if you were to take away this debt service, you'd immediately have close to $20 million of what you need to be paying, because you have the 11.6 million, and then you have the 8 million, which is the cash flow, the remainder that can go into investors' pockets, right? So he needs 20 million, or actually he needs to come up with 11.6 million for, let's just say, fiscal year 2020, and he's able to get a portion of that from, let's say, the cash flow. But really, at what point does the impact or ability to be paying the debt get hindered? And it's really once this number kind of goes away, this cash flow number. So if that were to go away, you would lose 15% of your occupancy from all your people at Del Rey, 20%, 21% of your people from Riverstone, 24 or 25% coming from Sawgrass, 27% coming from Naples, 38% coming from Breakfast Point. But then you'd also have to remove any sort of capital improvements. And that also being said, you probably would hire a skeleton crew to be operating like normal. Maybe you'd be having some emergency services, but I'm sure you could cut into this. So if you were to kind of immediately take that sort of aspect of things, let's just do a quick estimate of what the capital improvements cost. So it's around. Sorry, I knew what the capital improvements cost. About 800,000 divided by this. So immediately off the bat, you add this 2.4% to this 23.4%. You're looking at quarter of the money, kind of coming in. Of you basically need to lose 25% of your money right off the top. And Grant immediately just said, well, in order for me to keep the properties and do everything fine, as long as people pay their rent money in advance, by the way, keep in mind, he's getting this money in advance to make sure that he's fine with respect to paying the debt service that is in for the properties. He needs that 25%, to come up, very quickly. But he's basically saying cash flow might go away in the near term, but I can know for a fact that I'm at least going to pay this debt service in the future. And also keep in mind that doesn't include any sort of impact that he can do to the normal operating costs of the business. The normal operating costs, I mean, just looking at it, is $14 million out of that difference between $34 to $20 million, because the net operating income is everything after you're left with paying management fees and everything along those lines. So basically, he just needs to trim out a portion of that $14 million, and then he's got wiggle room. So the thought is are the businesses really that much in trouble? I mean, granted, you might have some people that are defaulting or asking for some forbearance with respect to, not having to pay rent immediately. But based off of what Grant's note was to investors, and actually I should pull that up quickly. So Grant's investor update, basically saying, as we work through these uncertain times in the next couple months, Grant and the team are looking to look at ways to be proactive. Very important for investors to keep up to date with what they're doing, how proactive to assist the tenants to maintain occupancy for the properties from Cardone Capital. We anticipate this approach will pay off in the long run, as it has in the past for Grant. So here are some measures that they took, and I think I've mentioned a little bit as well, but what they did in April so far to put everyone in a good position. If residents pay on time, they receive a discount. We kind of talked about that a little bit, but it's kind of generic as to what it is, but I think it dives a little bit deeper into it next time. Waived our credit card processing fee, so 1.5–2% of money, so making it easier for people to pay. They can put it on a credit card rather than having to pay in cash. I know if I paid on a credit card, it'd be like 2% back in the day. So if I was able to do that, I would probably do it, because you get points off that. That's $40 that I can get. 2% off $2,000, you know what I mean? That immediately goes back into my pocket. Late fees waived if they paid by the 5th. So, I mean, they're giving an extension of 4 days on the late fee. Working with tenants who need a payment plan. Jobs may have been affected. Okay, that's nice. We're renewing leases with no rent increase for the month of April. That's fine. And this has allowed us to take the renewal rate from 45 to 50%, which is around normal, and I would agree with that, to above 90-ish% for March. Residents will have an option to prepay for 3, 6 to 12 months and get bonuses and provide more stability for the tenants and the property. So if they prepay for the rent, they're going to get bonus savings on top of what they've already kind of agreed to pay. And that will obviously allow the property to kind of collect money up front to ensure that they have money to pay any interest. And some of these loans are interest only. Some of these loans are obviously full equity. You get some equity pay down on some of these loans as well. I think it's a portion of, I think Delray has equity, and I think one of the other ones has equity, but I think the other 3 are interest only. So far they said they've had positive feedback. Main focus is to keep properties full, maintain customer service, yada, yada, yada. And there's Grant and his team. So hope that was generally useful for you guys. But I think what I wanted to do was dive a little bit deeper into the numbers, show you guys that I lost half my money, jokingly or potentially seriously, of course, and really just give you guys an overview. I said a lot of people have been asking. I said I was going to give an update. I gave that original update in October timeframe. Kind of gave a follow up in December timeframe, and I said I'd come back once I got my K1 form. I fully anticipated I was going to get my K1 form sometime in February, but now I kind of understand that it's a partnership and you kind of have to have it get audited, and it's not as simple as say like a normal dividend. So you have to have it really audited by an accounting firm and things along those lines. So wanted to fully on go ahead and do that to well, they obviously want to go ahead and do that to be fully in compliance with whatever they need to do for the IRS. So yeah, I just wanted to take this time for you guys today and walk through some stuff. Hopefully you guys batter me in the comment section. I'd love to hear some more about what you guys are thinking, if I lost all my money, if I made a dumb investment. But if you haven't already, make sure to hit that subscribe button. And also, if you haven't already, check out the other 95% or so of the portfolio, because this is $15,000 out of over $370,000 at the moment. So don't forget that this is a very small portion of the portfolio. I did not concentrate fully on this. There's a lot of other content for you guys to be looking at. And as always, love to hear you guys in the comment section down below. Hit that like button and hit that subscribe button if you haven't already. Hope this one finds you guys great. I will see you guys in the next video. Cheers.